Hello. Today, we are going over 70 terms that new traders and investors must know. These terms will help you learn, so you can earn, and not get burned. Let's go.
A cash account is a type of brokerage account in which the investor must pay the full amount for securities purchased. For a trader with less than $25,000, the good with a cash account is you have unlimited trades of settled funds. For example, if you have a $1,000 account, you can make $1,001 trades in a day. The downfall with a cash account is the funds have to be settled. For example, if you have a $1,000 account and see a chance to triple your money but only have $15 settled, you can only use $15 to trade. A margin account is a type of brokerage account in which the broker-dealer lends the investor cash, using the account as collateral, to purchase securities. For a trader with less than $25,000, the good with a margin account is that it allows you to fully day trade your full account 3 times in 5 days without funds having to settle. Downfall: you only have 3-day trades in 5 days. Going over 3-day trades in 5 days will mark you as a PDT. It takes 90 days for it to reset after you've been marked as a PDT. Some brokers will waive PDT if it's your first time committing the offense. The reason they most likely do this is because you can withdraw all of your funds and trade elsewhere. ADR is short for American Depositary Receipt. These certificates represent shares of overseas stocks. ADRs allow traders to buy and sell overseas stocks on U.S. stock exchanges. After hours is from 4 p.m. Eastern Time to 8 p.m. Eastern Time. If you're not a seasoned trader, I suggest not to trade in the after hours unless you are closing a position. The ask is when a trader offers their shares for sale at a certain price. If a trader holds shares and wants to sell them at a particular price, they place an order asking buyers to purchase them.
Authorized shares are the total number of shares that a company can trade. It's always bigger than the public float. Averaging down is when a trader buys more shares of a stock as the price drops, lowering the average price paid for the position. This typically happens when a trader has purchased shares at a price too high and the stock continues to drop. Be careful in averaging down and not having a plan. Averaging down can work for long-term investors, but for traders it can involve losing more. Averaging up is when a trader buys more shares at a higher price because they believe a stock's run isn't over and want to benefit from the momentum. Bagholder is a slang term that refers to a shareholder who is left holding shares of worthless stocks. The bagholder typically bought in near the peak, when people were hyping the asset and the price was high, and held it all the way through steep declines, losing a lot of money in the process. They commonly find any shred of good news on said company to make themselves believe that the stock will see those highs again.
Beta is a measure of a stock's performance compared to the broader market. Beta can help traders assess the risk of holding a stock. A bid is when a trader in the market makes an offer to buy shares. Traders will bid for a stock at a certain price. The bid-ask spread is the difference between the highest price at which someone is willing to buy shares and the lowest price someone is willing to sell shares. Blue-chip stocks are large, stable, well-known companies that are often household names. For example, Amazon, Walmart, and Apple. These companies provide long-term growth, but the ride to get to big profits is much longer.
A buy is when you take a position by purchasing shares of a specified company. As a trader, you generally buy shares when you think a stock's price will rise. A death cross is a technical indicator that indicates the transition from a bull market to a bear market. This pattern occurs when a security's short-term moving average, e.g., 50-day, crosses from above to below a long-term moving average, e.g., 200-day. A golden cross is a basic technical indicator that occurs in the market when a short-term moving average, 50-day, of an asset rises above a long-term moving average, 200-day. When traders see a golden cross occur, they view this chart pattern as indicative of a strong bull market. Cryptocurrency, crypto, or coin is a digital currency designed to work as a medium of exchange through a computer network that is not reliant on any central authority, such as a government or bank, to uphold or maintain it. Some well-known cryptocurrencies are Bitcoin, Ethereum, and Dogecoin. Elon Musk infamously referred to crypto as a hustle, as a host on Saturday Night Live.
A day order is a market order that's expected to be filled during the day. If it isn't filled during the day, it's automatically cancelled at the market close. Day trading is the practice of entering and exiting stock trades within a single day. For example, if you purchase a stock at 10 a.m. and sell it at 5 p.m. Eastern Time, you've day traded. Diamond hands isn't referring to the big diamond ring you've got in your spouse. Diamond hands is a slang term which refers to an investor who doesn't sell a stock no matter the downturns or losses. Many diamond handers practice averaging down and averaging up because they believe that the stock will rebound and give them astronomical gains. A dividend is when a company pays a portion of its earnings to its shareholders. Long-term investors and retirees generally focus on dividends. A dividend is essentially the company saying thank you for believing in and supporting us. Here is a small token of appreciation. Some look at it as an incentive for investors to buy a stock. Dividends are typically low and usually don't work for the younger, poorer investor.
A dividend yield refers to the size of a company's dividend compared with the price of its stock. In general, dividend yields of 2% to 4% are considered strong, and anything above 4% can be a great buy but also a risky one. A too high dividend yield indicates the payout is unsustainable, or that investors are selling the stock, driving down its share price and increasing the dividend yield as a result. Execution is the fulfillment of a stock trading order. For example, you place an order with your broker to buy 20 shares of Amazon at $10. When that trade is completed, that order is executed. FOMO, commonly known as fear of missing out, it's when a trader is undisciplined and sees a stock rally, doesn't do any due diligence or rely on technical analysis and buys at a very high price. FOMO can burn you most times and rarely pays off. Don't succumb to FOMO. Forex is short for foreign exchange. The term refers to the global trading of currencies in a way similar to the way stocks are traded. ETF is short for Exchange Traded Fund. ETFs are similar to mutual funds, they're pools of capital used for investment purposes. But instead of wiring your money into the fund, you can purchase shares of the ETF on a stock exchange. Hedge funds are a type of investment fund that often uses non-standard investment and trading techniques.
Mutual funds are pools of investors' capital for investing in stocks, bonds, and other financial assets. When going long, you purchase stock shares hoping to profit from an increase in the stock price. When going short, a trader tries to profit from a stock's dropping price. Short sellers borrow shares from a broker, sell them, and hope the stock price declines. They then buy the shares back and return them to the broker. Short sellers typically have the mentality the glass is half full, but let's empty it. A growth stock is a stock of a company that generates substantial and sustainable positive cash flow and whose revenues and earnings are expected to increase at a faster rate than the average company within the same sector. IPO stands for Initial Public Offering. It's when a company goes through the process of selling shares on the stock market for the first time. Level 2 is an order book. It is intended to display market depth and momentum to traders and investors. Many traders and investors set their sell and buy orders near big orders because big orders are commonly believed to move the market.
Liquidity is the measure of how easy it is to buy and sell a stock. Locking in profits refers to the realization of previously unrealized gains accrued in a security by closing all or a portion of the holdings. In short, it's insurance. A trader or investor may sell a quarter, third, half or more of their shares and keep the rest in order to make unrealized gains, realized gains. They then hold some for a possible continued upward move. Margin is when traders borrow money to trade shares. With margin, you can make money and lose money faster. Check your broker's fees and your risk assessment before trading with margin. A bear market is the opposite of a bull market. It's a market in which prices continuously fall. Bear markets are times when the outlook seems bleak for a company, an industry, or the overall economy. Traders and investors are less willing to buy stocks, and many are looking to sell. This causes prices to fall. A bull market is a market condition where stock prices are continually rising. Bull markets are characterized by optimism and excitement from traders and investors. Market capitalization, notoriously known as market cap, is the total value of all a company's shares. For example, if a company has 2 million shares outstanding and the stock price is $5 per share, the market cap is $10 million.
Meme stocks are stocks whose trading volume increases not necessarily because of a company's performance, but because of social media attention, which may result from a variety of factors unrelated to the company's performance, financial position, or other business fundamentals. GameStop is regarded as the first meme stock. A moving average is a common technical indicator traders use on stock charts to see a stock's price trend. The moving average is an average of the stock price over a certain period. For example, the 20-day moving average is calculated by taking the price of the stock on each of the prior 20 days, then finding the average of those 20 prices. Most common used time lengths are 20, 50, and 200. An offering in the stock world is the issue or sale of a security by a company. Secondary offering is when a company raises money by offering shares, even after the company's shares are traded on a stock exchange. This is called a secondary offering. A good till cancelled order is a market order that remains open until you complete the trade or cancel the order. Also known as a GTC order. A limit order is a type of stock market order that provides instruction to only execute at a certain price. For example, a trader could place a limit buy order to purchase 100 shares of a stock at $4.20. The broker will attempt to buy 100 shares at a price of $4.20 or less. As a trader, this is the type of order you most commonly want to use. Inversely, a limit sell order sells at a certain number or higher.
A market order provides instruction to buy or sell as quickly as possible, at whatever price is currently available. Market orders can be expensive if there's not enough volume. You typically don't want to use these. It's like going to the mall and giving the merchant a signed blank check. Outstanding shares is the total number of a company's shares. It includes both the public float and restricted shares. PDT. Pattern day trader. You need $25,000 or more in your account to day trade unlimitedly. If you've been marked as a PDT but don't have $25,000 or more in your account and it's your first time, ask your broker if they will allow a first-time warning and reset your day trades. Some will do it as a first-time courtesy and the additional fact that you could easily take out all of your funds and start over with a different broker. A penny stock is technically any stock whose price is under $5. Power hour in the stock world depends on who you talk to, but most observers can agree that it is the first and last hour of trading. Power hour is when emotions and activity is at its highest, causing volatility to be higher than any other time. The pre-market is 4 a.m. Eastern Time to 9:29 a.m. Eastern Time. It's riskier to trade in the pre-market, especially when it's early in the pre-market.
Buying pressure is when the majority of investors are buying, indicating the majority think the market price will increase. Inversely, selling pressure is when the majority are selling, thinking the market price will decrease. A price quote is a stock's price at a certain point in time. Traders will often want up-to-date price quotes to better analyze stocks and find decent trading setups. A price rally is when a stock price rises at a noticeably quicker pace. Public float is the term for a company's freely traded shares. As active traders, we often look for companies with a low float, as their prices tend to be more volatile. Stocks with lower floats typically provide bigger gains in a day than a stock with a much bigger float. Rocket is a term traders use when a stock is about to, or goes up by a lot in a short period of time.
Sector. The stock market is made up of shares of companies in different industries. Those are referred to as sectors. When a sector is hot, sometimes stocks in that sector receive a price boost. Sell. To sell the shares you currently own. Traders generally sell shares when they see an opportunity to take profits or they think the stock's rise is coming to an end. A short squeeze is an unusual condition that triggers rapidly rising prices in a stock or other tradable security. For a short squeeze to occur, the security must have an unusual degree of short sellers holding positions in it. The short squeeze begins when the price jumps higher unexpectedly. After a heavily shorted stock has squeezed, you do not want to stick around and hold the bag. A stockbroker is an agent that allows traders to buy and sell stocks. Stock charts are a visual graph of a stock's price over time. Traders use stock charts to help them interpret a stock's price action and pattern. A stock exchange is an entity where stocks are bought and sold. The most well-known stock exchanges are the New York Stock Exchange and the Nasdaq.
A stock portfolio is an investor's collection of stocks. Stock symbol or ticker symbol is a unique collection of letters and/or numbers that represent a stock. Amazon, for example, trades on the Nasdaq under the symbol AMZN. Swing trading is a speculative trading strategy in financial markets where a tradable asset is held for one or more days in order to profit from price changes or swings. A common example of this is when an investor buys a stock a few weeks or days before an expected positive earnings report. A sympathy play typically happens as a result of another stock's earnings and/or news. It can cause another stock or sector to move despite not having any news. It's moving in sympathy.
A technical indicator is a mathematical calculation based on historic price, volume, or open interest information that aims to forecast financial market direction. Trading volume is the number of shares being traded at any time. More trading volume means more liquidity. Volatility is the measure of how much a stock moves up or down. Stocks that move up and down wildly are known as volatile stocks. They can provide great profit opportunities, but also come with greater risk. One minute you can be up 15%, next minute you can be down 5%. Think of it as a wild roller coaster ride. If a lot of buyers and sellers are actively trading a certain stock, you'll usually find it easier to enter and exit a position.